I speak to people in all sorts of different places, different countries, Africa, Asia, and they're telling me on the ground what's happening. There is not a lot of food, and the price inflation is through the roof.
Who's hungry and unhappy, because if they got nothing to do, they're going to come storm your castle. There's another outcome, which I will say will maybe more probable than a system reset, is a war. I don't use cash. I don't carry cash. So rob me, mug me, you can take my credit cards, you get nothing.
So I just want to say to my viewers, I do recommend, ladies and gents, you do have some cash and metals, but we'll have to agree to disagree on this one, Steve, because I have a very different opinion. But that's that.
I am personally expecting the equity market to completely collapse.
Ladies and gents, welcome to the show today. We've got a very special guest. By very popular demand, we have Steven van Metre, the Bond King, and also has a macro show on YouTube. So welcome to the show, Steven.
No, it's a pleasure to be here today. Thank you for having me.
Yeah, you're welcome. So in today's interview, ladies and gents, just a couple of talking points we're going to be going over with Steve. We're going to be talking about the bond market, because obviously, you know, he's the bond king. So we're going to learn some stuff about bonds here, why the bond market is so important, the sort of thing it teaches us about the economy, how it helps with forecasting and the like. We're going to be talking about one of my favorite topics as well, and that is the future. So looking forward, we're going to be looking at the dollar, the collapse of the dollar. Will that happen? We'll ask Steven's opinion if he agrees with me about that in the future. Fed asset buying program, quantitative easing, inflation. Is it transitory? Is it not transitory? We'll be asking Steve this. Interest rates, and we're going to be talking about disinflation. I'll explain what that is very shortly. So firstly, please remember to click the like button. We need all the likes we can get with the way the channel's going at the moment, and YouTube. I don't know if you've had much of this, Steve, but we're having a bit of a challenge. And please just remember to subscribe if you haven't. So, Steve, welcome to the show again. Thanks so much. We really appreciate you being here.
Oh, the pleasure is all mine. I'm glad we could connect and have this chat today.
Yeah, everyone's going to be so grateful for this conversation. So the first thing I want to get started with is around just a basic overview. So obviously, everyone knows you as the Bond King. Can you just tell us a little bit about bonds? Give us a very short overview on why bonds are so important within a portfolio or within the markets. What do they tell us?
Well, I think the great place to start, Noah, is why should you even look at bonds? Because nobody cares about them for the most part. I mean, there's more bonds being traded than equities. But, you know, you don't go to a party and be like, hey, man, did you get one of those new 30-year treasury issuance? Like, nobody talks about that, right? It's the IPO, the crypto, the hot stock. You know, and that's what we want to hear about. But, you know, from a macro perspective, why should people even look at the bond market? I mean, maybe they don't want to trade it. Maybe they don't want to invest in it. That's fine. But what should you know about it? And the real key to the bond market is it tells you if financial conditions are easing or tightening. And, you know, we brought the arrows along for the day's show. So, you know, I like to use these in my YouTube show. And when financial conditions are easing, interest rates go up. It tells you credit's being created, money's being created. And that's a good thing if you're in an expansion. You want to see interest rates go up. It validates higher equity prices. But when you see interest rates go down, a lot of people say, well, that's great because you can buy stocks on margin and for less interest. You can do all those things. But when interest rates are falling, it tells you financial conditions are tightening. And if you look at a long-term relationship between equity prices and treasury yields, what you find is when yields go down, stock prices follow with a lag. And it could be the same month, but upwards of 6 months. And the same thing is if you have rising equity prices, well, you better have rising treasury yields because they validate each other. So you don't get one without the other. And so when we look at the bond market today, we see it almost breaking through a topping pattern. 30-year treasury yields last night came down to 2.2. We look at this beautiful rounded top with a neckline, and it's telling you, hey, warning, 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 financial conditions are tightening. And investors, are too busy clicking the bid on stocks to even notice it, but it's telling you something isn't right in the equity market, or it may not be right for a whole lot longer. So I think the bond market's important to learn about, even if it's not something that you trade. It should be something to look at.
Okay, that's quite interesting that you say that, because this is a question I was going to ask you later on, which a lot of the viewers, they submitted through our private community all the questions for you. This one was one I'll save until the end, but I'm going to ask it now then. And that is, a lot of people voted this up, and they said to ask Steve, what does he see as the likelihood of a stock market correction? Well, I'm using the word correction, but they use the word crash in the next 1 to 2 years. So what do you see? What do the charts say?
I'll say there's 100% chance of that. And that's a bold statement, because you should never say anything's 100% of anything. But if you look at financial conditions, again, we come back to the bond market, it's telling you financial conditions are tightening. There's a lot of debt underneath the equity market. The global economy is starting to roll over. You see that coming out of Asia, not so much the U.S. data, but that will lag because the U.S. is a large importing nation. Our data is going to lag. So if you look out, say at China, you see that their manufacturing sector is peaking out. You're starting to see that. So the issue is, will the equity market crash? The answer is absolutely yes, because if you look at quantitative easing, and now we're going to talk about Noah, but if you look at quantitative easing, it's designed to tighten financial conditions. We're seeing that now in the bond market, which is interesting, because back starting in August of last year, we saw the largest selling and speculative shorting event in the 34 and a half years or maybe 35 years of the Treasury bond market. So everybody went massively short this thing, and it still didn't go up that much. I mean, 30-year got a little over 2.4, maybe 2.5. I mean, not much for the amount of effort here. Now we're seeing it tighten on the back of the Fed buying a massive amount of treasuries, 80.5 billion. Looking at 120.5 billion if you count all the mortgage-backed securities, which we should, and they're very relevant to the picture. You've got large commercial banks flooded with cash, forced to buy bonds to back all these deposits, and you've got foreign central banks also buying bonds, just as part of the cycle of what they need to do to keep the dollar cycling through the global economy. So, when you have all these big powers still buying bonds, and everyone's short, well, you're going to get a massive short squeeze. You get financial conditions tightening, and then the wheels just literally fly off the equity market. So I am personally expecting the equity market to completely collapse in the next year. Yes, in 12 months. Yes, I don't think I'll have to wait 2 years to see that.
Okay, so two questions, and the first one will be an easier one, is for you to just explain what you mean by the equity market, because different people have different sort of explanations for it. And then the second one that leads on to then is, what do you see as the trigger then for the stock market to sort of start coming down? So let's just start with the first part then.
Yeah, I expect to see U.S. equities, foreign equities, commodities. I expect to see foreign currencies and high-risk bonds like high-yield bonds, emerging market bonds. I expect all those things to go down. What I expect to go up, this is not a popular opinion, the U.S. dollar and U.S. Treasuries. Of course, U.S. Treasuries are just a deferred form of U.S. dollars. And for your listeners, I want you to think about this, because I like to challenge people to think about tools and investments. You put dollars in a bond, maybe say a 5-year T-note, and what do you get 5 years later? You get your dollars back. So you have to think of bonds as a deferred dollar. So if financial conditions are going to tighten, well, then the two things you own are dollars and U.S. Treasuries, because everything else tends to go down when that happens. So what do I think is a catalyst of this move? It's the Fed. I mean, if you look at what the Fed is doing, everyone thinks quantitative easing is money printing. It's not. Everyone thinks that quantitative easing is designed to cause interest rates to go up. It's odd. To me, it's wholly odd that you have someone coming in, and I visualize this as like a grocery store, and buying up all this certain inventory, buying inventory every day. And the answer is, well, prices have to go up or down. They're trying to drive prices up of bonds and interest rates down. That's what they're trying to do by reducing inventory of Treasury. So you look at QE, you've got, so to me, the Fed's a catalyst, right? You have QE designed to tighten financial conditions, trap dollars into the commercial banking system, lower interest rates. The Fed is the catalyst here, and we know that the probabilities of this happening and them being the catalyst is high, because we can look at the lending data and we can see that we're not getting any lending growth. And you can go back to QE 1, 2, and 3, and people like to look at that and say, well, look, it did all these great things. I said the key difference between then and now is then QE lowered interest rates enough to spur lending growth, which caused rates to rise. And that's where we get this perception that, oh, interest rates go up due to QE. Well, it's because it lowered them enough to spur lending growth. Today, we're seeing a contraction in lending on a year-over-year basis, even on a 3 and 6 month rate, telling us interest rates are too high. So the Fed, to me, is the catalyst. They're the one that breaks everything. No one sees that coming.
Okay, so question then, let's jump over to stimulus, and then we might loop back to this. So if you don't see QE as inflationary, do you see the stimulus checks as inflationary?
Yeah, absolutely, but only on a temporary basis. As long as it's hard to argue that you give people money and they go out and spend it. We just had this confluence of everything was shut down and we gave people money. I mean, we can go back to prior stimuluses and we can find out that in a normal function economy, they don't really do much. I mean, a little bit. And that's because about a third of the stimulus is spent, a third is saved, and a third goes to debt payoff. So if you break down this pie and you say, okay, a third goes to spending, there's your inflation, right? Mm-hmm. And then you look at a third goes to debt payoff. Well, that's just destroying money. And then a third goes into saving, which doesn't do anything. I mean, well, arguably it forces the banks to buy more bonds. So you look at the stimulus and you see that, okay, this thing, it can't do much. Now, if you have persistent stimulus and an economy that's persistently shut down, so we're artificially driving the price of goods and services up, yeah, you can get it. But the moment everyone goes back to work and the stimulus goes away, then you should see the inflation go away. And I suspect if we don't see that this week, or start to see it this week, and we are seeing some of it in terms of the CPI data out of the other parts of the world, we're starting to see disinflation. We may not see that here in the U.S., but if you look at the year-over-year rate change in crude oil, which energy is a very volatile part of the CPI, it suggests that the CPI print this week could be disinflationary on the month over month. And if not, then I suspect the following month, especially due to the base effect all coming up from their pandemic lows, we'll start to see this, inflation roll over, become transitory. But coming back to the original question, can stimulus be inflationary? It can. You've just got to keep doing it, and we're done. And we're almost done. I think there's still some checks to go out, but overall, it's pretty much done.
Okay. So you see the stimulus as inflationary, but on a short-term basis. That's what I'm getting from that answer.
Correct. Very transitory.
So what about the inflation that we're getting at the moment and that we're seeing at the moment? Do you see that as transitory?
Well, absolutely, because the economy is shut down. So you give someone, still parts of it are shut down, where you give someone money, they want to go buy something. There's not very many of them being built because we either can't get them in the country, can't get them from the ports to the store's not fully open, or there's a part missing. And people are like, well, I got an extra $1,000, whatever their check was, and they don't care because it's not their money. So it's like, oh, well, it's an extra couple $100, fine, boom, I got the money, I'll pay for it. So yeah, you see all this inflation is going to be transitory, especially since without the stimulus checks, incomes are going to go below where they were. So you think about that is, well, if my income is going lower than before and I don't have a job, or maybe I do have, or maybe I get a job and that job pays less. And if I don't have a job, well, unemployment's going to be a whole lot less. How can I drive inflation if my spending is going to go down? That's the real key. Everyone's, it's just weird to me, Noah, that for 40 years, we've been in a disinflationary environment. The Fed has done many things to create inflation. And the federal government has done stimulus and has done deficit spending. And all of a sudden, you shut the global economy down. You give people some checks, and now people think we're in a secular bout of inflation. And the reality is that's not going to happen. I mean, you can go back before the pandemic, and you can see we were at full employment to the government statistic. And what did you see? Disinflation. So the notion that somehow all of this is going to turn into some massive secular demand for goods and services, I'll argue the fact that the stimulus checks created that demand, and without them, you're going to have an extended period where people aren't going to, not only not going to need things, they're not going to have the money to do it anyways. So yeah,
Yeah.
I expect all of this to be very transitory.
Yeah. I mean, I think the stimulus was part of the inflation. I don't think it was the whole thing. For me, when I look at the close down of globalization, and we look at this, and I have clients that say I used to pay 6,000, 8,000 for a shipping container, and now I was quoted 60,000 for that same container to get it from China into the USA. We have to, are you looking at these as well? Do you accept that's also contributing towards the inflation?
Well, yeah, because everyone's trying to get their stuff over to the U.S. to capitalize on these high prices, and I don't blame them either. If you look at the pandemic, was phenomenal for U.S. producers because U.S. producers are generally higher priced. Well, couldn't the ports were closed? You couldn't get goods in. So the U.S. producers did real well. Now, if I'm outside the country in China or some of maybe South Korea, what do I want? Man, I've got my lower priced goods. I just need to get them there because I could maybe capitalize on these higher prices for a little while before they come back down because I'm the low marginal producer. I'm going to drive prices down. And I think that's one of the challenges is everyone's looking at the U.S. almost like an island, but we're in a global economy. So the notion that the U.S. is going to see artificially high prices where you have low price producers elsewhere, not a chance because, I mean, that's just capitalism. If I could sell you something at a lower price, or I could sell you at a higher price where my cost is lower, I'm going to do it all day long until I drive the price down. And that's what globalism does. So, yeah, I think we just had the perfect storm where now people think, and I'll add to the whole thing, though, is people do think that, and I still talk to people today that think these government stimulus checks are printed money. They don't actually know that we borrowed it. So they think that somehow we just ran the printing press and gave people money. No, we borrowed money, everything was shut down, and all this is going to pass through the system much quicker than I think the market is expecting it to.
Let's look at that then. So if we look at, in fact, let's jump back to QE because, as you know, I had Peter Schiff on my show not long ago, and we had a very interesting discussion there. There was a bit of this going on, in terms of me and Peter there, especially around QE and a couple of other things. So he said recently, and I don't know if this was aimed at you, Steve, or not, but he said, all these people, these people who are this expert, that expert, and whatever, and, I'm guessing he was talking about you, but he's saying there's no QE, the QE doesn't get into the economy and cause inflation. So I don't know what they're talking about and where are they getting this from and whatever. I'd love to hear, because a lot of people have asked me, why does Steve say that QE doesn't get into the economy? And they're saying, why is it that each time QE is produced, not long after, you see asset prices spike up? And they're saying, there's 5 or 6 different things here and it's correlated. Why is Steve saying there's no relation? That's a tough one for you.
Yeah. It is, because I'm relatively sure Peter Schiff has no clue who I am. I'm pretty sure of that. Is people are looking at the cause and effect wrong. So, again, is there any mechanical part of QE that magically makes stock prices rise or home prices rise? No. In fact, if that were true, then March of 2020 should have never happened. Should have never happened. We should have never seen stock prices fall. And they did. We were doing QE then. So what is the problem? Well, we're not doing it up, but the argument is we were doing it. So how do you have a 30% drop in equity prices if QE magically makes things go up? What people are missing is the speculative behavior caused by low interest rates, and that's as simple as looking at a chart of margin debt. So people are like, well, QE makes asset prices go up. Or do they make people go out and borrow money and buy risk assets? That's what it does.
I see.
So in itself, it doesn't do anything. In fact, if the Fed could control it better, they would probably not want people speculating on risk assets. They probably would see it going into discretionary spending and other things that truly create inflation. But people just jump from one thing to another without actually dissecting how it works and saying, look, it doesn't have anything to do with stock prices. In fact, there's no part of it that has anything to do with it. But I will challenge everyone's thinking. What will change the world's mind is when we have a deflationary crash and we're still doing QE, because we shouldn't. The broad view is asset prices cannot go down and the Fed can just magically turn a dial and make them go up. That will change the world's thinking. And that will actually cause a lot of sentiment change and drive risk assets down as people panic and sell because their world belief is going to be challenged and changed. I'm looking forward to that, seeing how that plays out. I think it's very interesting. It'll be interesting to see how it goes. But yeah, I don't see any mechanical part of QE that causes my house to go up in value or my stocks to go up in value. It doesn't exist.
Okay, so I can see what people are seeing now that I've heard your answer. So I think it's where you're saying you can't see any connection, but there is a connection. It's just not the exact connection that people think you're saying. So what you're saying is it's not as a result of the QE, it's a result of the low interest rates and then people then going out and doing it. So there is a connection, it's just not a direct connection is what you're saying.
Well, yeah, and so what happens this is where it gets interesting to me, is because people can't fathom the stock prices can go down. But if you look at what QE does, is it tightens financial conditions until it spurs enough credit growth to ease them. So the Fed's continuing to tighten things. So if you're tightening things, there's less money. And at some point, there's less money to support high stock prices, high real estate prices. Yeah. If there's not enough money to support them, then all of a sudden you get the bearish arrow comes out and the down stock arrow comes out. And that is what will challenge people, because the answer should be we should be able to just shut off the stock market, right? Just say, look, nobody can trade today, and the Fed's just going to do QE, and at the end of the day, stock prices should magically go up. And I guarantee you that won't happen, because it's a market. You need buyers and sellers. The problem is right now is people think, they think, okay, QE makes asset prices go up, so I'll just borrow money and buy stocks. Well, which one really made them go up? Which one's really making home prices go up? Is it all these people that run around buying homes? Or is it the Fed? I will say it's all the people buying homes and all the people buying stocks.
Okay. I'm glad we clarified that, because that was actually, just so you know, that was one of the things that a lot of people in my community were saying. They were saying, Steve's saying there's no connection, but there must be. And now I think that clarifies the point there. So I think that's important. The next thing then is, in terms of QE, I don't know if you've heard my theory on tapering it off over the next 2-3 years, but I'd love to know what your theory is on the tapering off. How do you see that occurring? Do you see it similar to the 2008 crisis we went through? Do you see it differently this time, and why?
Yeah, okay. So this is cool, because I want to marry the last conversation into this. And now we're coming back to, why is the bond market so important? Because what is it telling you? It's telling you yields are looking like they're headed down. It's telling you financial conditions are going to tighten. And I'll challenge all of your listeners and viewers to look at the long-term relationship between yields and stocks. Yields go down, stock prices soon to follow. So now the question then becomes what's the Fed going to do? More QE, which is brilliant, because now you start getting into my macro thesis, and people are like, well, how can you even like bonds? Because the Fed's, not only does the Fed buy a lot of them, they're going to buy a whole lot more. And I'll tell you why. Because when financial conditions tighten as interest rates go down, which we know is going to happen, the Fed has two choices. What are they going to do? Are they going to raise the federal funds rate and do quantitative tightening? Probably not. Or are they going to, they can't lower the federal funds rate, it's effectively at zero, or are they going to do more quantitative easing? Well, they've convinced the world that QE eases, and the world is convinced that QE eases. So they're going to do more, which is going to hyper tighten financial conditions, cause a crash, drive interest rates to zero, or they're very, very close. Across the curve, you're going to see short-term rates go negative, and probably intermediate term go negative, and maybe long-term rates will get to zero. And if they go as in negative, we got deep problems. But the Fed's going to do more QE because everyone believes it works. They believe it works. And all it's going to do is crash things, and then the Fed's going to turn around and say, not our fault, it's the pandemic and everybody else not doing all these things that we thought they should do. They got a free pass out of this, but it doesn't matter. That's how the end game plays out. Financial conditions tighten, Fed does more QE, and all it does is tighten financial conditions even more. But the great part is it will lower interest rates enough to hopefully spur credit growth. And that's what we saw in the financial crisis. They drove rates down enough through QE to spur credit growth. The only question now is, how low do they have to go?
Yeah. I think that raises another question in terms of how do you then come out of this? Because look at Japan. They've been in this for a long time now. So it shows how long this can go on for. And again, this was another point that I've argued with guests sometimes where we get into this thing. Whereas I don't think that we're going to go into this hyperinflation that people are predicting in the next 18 months, 2 years. I just can't see it. I can't see it. I can't see a hyperinflation occurring because you've got to look at how this is all driven. You have the media involved. You have the Fed involved. You have politicians involved. The politicians are not going to do something to upset the people because then they're going to get thrown out of office and all this. So they're going to keep trying to appease the people, right? I mean, this is all linked, and the media really is one of the people controlling all of this in conjunction with the Fed as well. And as I always say, if you look at the Fed and you look at the history of the Fed, you go back a long way. It's always a psychological game first before a monetary game. It's all psychological. Look what happened when, I think it was Yellen or Powell recently talked about, we may have to do this. What happens to the stock market? It started dropping for a couple of days because it's a game of psychology. It really is. So that brings me on to another question then. What do you see with interest rates over the next 6, 12, 18 months, however long you want to go out to?
Well, if you don't mind, I want to comment on what you just said.
Yeah.
I think there's some interesting stuff there because you just posed a question of how long does this last? And everyone says, oh, it's not going to be wrong. V-shape, right? If it goes down, it's going to just rocket right up, buy the dip. But how do you get inflation? See, I think it's a real question. I think we should be asking the question instead of, well, we're going to have inflation. So how do you get inflation? Well, the way you get inflation is people go out and overconsume what is available. If there's 100 widgets to buy and 1,000 people want to buy them, guess what you can do? You can drive prices up. That's how you get it. So if you think about what we just did, we pulled aggregate demand forward. Now, for those who don't understand what I'm saying is we gave people money and said, go buy some stuff today that you might buy 6 months, a year, or 2 years from now. Buy it now. And they did, right? They buy electronics, they buy cars, they buy homes. I mean, they're buying everything. So what's going to happen now, not only when those checks are gone and incomes are down, but they don't need that stuff because they already bought it. That demand's gone. The second problem that nobody's factoring is you've got a massive amount of wealth concentrated in the baby boomers. What if the stock market goes down 25, 50% again? What if that happens? Is their spending going to be like, well, guess we'll just take what we got left and go, have a party? No, they're going to stop spending. That's the problem here, is in order to create inflation, you need to have demand. So we're not going to have it. That's the problem. And so you start thinking about what will the Fed do? They'll do more easy. Like you said, I mean, in the end of the day, the Fed, they'll say they're not political. All right. Yeah. Powell is effectively elected by the president, right? He's not elected, but he just, hey, I want this person, and Congress generally says, yeah. That's cool. So, the first rule of every politician, goal of every politician is to get in office. The second one is to get reelected. Like, that's the two goals. So if you're in office, you're going to do what it takes to get reelected. And in Powell's case, what is he going to do to help President Biden look good? Is he going to, again, do something called quantitative tightening, which nobody likes the sound of that, which is what we should do, or you can do quantitative easing. And he's going to do so much quantitative easing that he's going to stop and say, look, I've done everything I could. I'm doing $1 trillion a month of this stuff. I don't know why it's not working. It's your problem. Congress is your problem, President. But look at me. And by the way, when my term's up soon, you should put me back because I did everything I could to make you look good, not my problem. So yeah, I think the worst part of this is we're going to go through a prolonged period of deflation because there won't be any demand. The boomers in retirement with less money are going to spend less. And then everyone else is going to have, you look at the millennials, I mean, of all the generations, they have all this debt. And they're facing, they came into a weak job market to begin with. I mean, as a generation, if you look at their inflation-adjusted wages compared to the boomers, they're not that great. So the millennials really need asset prices to come down. The problem is when they do, they won't be able to afford them right away. So you look at the system and it's just ripe for destruction, and it is ripe for a prolonged period of deflation, because even if rates were zero and people don't have the money to spend, what are they going to borrow and spend on? If I just bought a car and a home, am I going to go buy more? Probably not. And so you look at the situation, and yeah, I think things are bad. So where do I see rates going for? They're going to be low. I mean, Japan is a perfect example. I mean, they've got 0% interest rates, and they can't get inflation, can't get growth. What's the real difference? Is it their population? Is it the behavior? I don't know. There's no difference. They have the same demographic problems we have. They just have them first. So here in the United States, yeah, I mean, look, we may get a big bounce because everything's so low, whatever money can flood in, it floods into the equity market, but it won't last. The broad economy is going to be severely damaged.
Okay, interesting. So let me come on to another point then, and that is something I call the great deleveraging. I'm guessing you know what a deleveraging period is. Yeah. So if you look at, I don't know how your history is on the Great Depression, if you've studied much into the Great Depression and the Great Financial Crisis. Okay, good. So this question should be okay for you then. So if you look back then and you were to compare the two, and you look at where we are as a society right now, and I always try and educate people that during the Great Depression, 29 to 38 sort of period, real estate, stock market just came down 80% in some cases. And people say, that could never happen. It's never, and it makes me laugh when people say, that's never happened before. Read your history. These things have happened before. Do you think it's possible that we could go into another great deleveraging during this period, once we get to the end, obviously, of this crisis? Or do you think it could be closer to an 08 crisis? Or do you think it could be closer to a Japan crisis? Because really, with all of these, I'm pretty certain of how we're going to end all of this. But all my viewers know this. I think we're going to they're going to try and do some sort of a reset on the currency, cBDC, central bank digital currency. They're going to try and just wipe the slate clean as best they can of the middle class, obviously, not the wealthy. But I'd love to just hear your opinion on just some of the points I mentioned there. Do you see a Great Depression sort of style? Do you see a Great Recession, so that's the 08 period, or do you see Japan or something else?
Yeah, great question. And I'll add to your 80% stock decline. People can look at the NASDAQ from the tech bubble bursting too. So yes, couldn't happen again, and it did. The reality is we have too much debt, so the probable outcome is more of depression style, because again, we come back to, what if rates were across the board were zero? Is there enough demand for consumption? And so you look at, how do we get through 08 and 09? Is you had baby boomers still working, relatively, maybe not at their peak earnings, but relatively high compared to their overall, work cycle, and they just kept putting money in their 401ks because, well, they couldn't retire. They were in their 40s, late 40s, 50s, early 50s. They weren't there yet. It wasn't possible. So they just kept putting money in, and that helped a lot. But without them, we have a lot of problems. So you look at all this debt. How do you deal with debt crisis? Either you, like you said, you wipe the slate clean with something new. I actually don't think we're going to do that. Or you go through a deleveraging cycle where you realize that everything you've tried just hasn't worked. And so you give up and you just, well, I guess we'll just start paying everything down. There's another outcome, which I will say may be more probable than a system reset, is a war. And you look at war cycles tend to follow recessions or depressions, because now you got a problem. You got a lot of people out of work. And if you're rich or powerful or both, the last thing you want is 80% of your population, or 90, nothing to do, who's hungry and unhappy. Because if they got nothing to do, they're going to come storm your castle. And generally that doesn't work out for people in power. So what do you do? Well, wars get started. It creates consumption. It creates demand. And it gets rid of people. And I know that sounds really rude. And if you look back at history, why do we have major wars when there's recessions and depressions? It does have a function, and it's a great deleveraging cycle too. Because look, if you're if you're out, producing war goods and you're working in a factory, maybe you're not out, fighting the war, but you're in production. Well, you're told don't spend, don't do this. We need all these materials. We need all this stuff. And so what do? You pay everything off. And you start looking at it like World War II. Why did the U.S. economy come out so well? Well, one, our country wasn't devastated by, the infrastructure wasn't devastated, but as a population, I didn't have any debt. It was all, a lot of it was paid down. So consumers were like, man, I'm ready to go spend, and I don't have all the debt anymore. And so, yeah, as morbid as it sounds, you look at historically why you see recessions, depressions, and you get war cycles is because, look, I'd rather have, if I'm, again, in power or, really rich, what do I want? I want all these idle people going and doing something else. So rather than coming and fighting me and taking me out of power, hey, let's find an adversary and make them go fight each other. Mm-hmm. Yeah. And again, but I just challenge people's thinking is to look at how the world works. Why do these things happen? There's a reason. So, I don't see a system reset. I think that's very hard to do. I don't think digital currencies solve the problem because, again, you look at the system is the problem. But how do you change a global reserve system fast enough? You can't, because now effectively you're telling everyone, oh, by the way, everything we've ever done and ever taught you and it was all wrong. Can't do that. People, again, lose confidence, and what are you going to do? There's a reason guillotines were invented, is to get rid of kings and queens. So you think about people in power. How much do you want to tell people that the system they're living under is flawed, that you've got to revamp the whole thing? By the way, we have nothing. We've never even started down that path. So we don't even have a template of saying we could do this. It'll take years. So the simple answer is you get a recession, and then probably somebody gets mad at somebody and starts a war. As much as I don't want to see that happen, I see that that's the more likely outcome historically.
Interesting. I thought you may mention the fourth turning, House. I don't know if you've ever read up on the book.
I'm still working my way through it.
Yeah, but it's pretty clear to me that we're probably in the fourth turning now. Anyone who tried to argue this with me, their argument's been extremely weak so far, because all the evidence points towards we are in this period now, and we're going to see a lot of instability for at least the next 5 years, if not the next 8 to 10 years. I just can't see the boom that a lot of people are seeing, over the next 5 years. I can't see it personally. But I do feel after that period, even if it lasts a decade, we're probably going to see a new form of renaissance period. It's going to be great. Everything's going to be amazing. But you're right. I do think we're going to see conflict. Now, the real question is it going to be internal conflict, or is it going to be global, a global conflict? Either one is not going to be good. But if you look at a lot of wars and why they started, a lot of it's resources anyway. It's resource based. You look at a lot of conflict. When I was in the military, it is only afterwards when I look back on my service, I think, oh, I wonder why I was in that country. You don't ask questions at the time, but was I ever sent to, somewhere like Zimbabwe when everything was going on, the craziness? No, there's no oil in Zimbabwe, right? Most things are resource-based. So I think you've got a good point there. And if we do go into any sort of shortages, I think we're going to see some food shortages, for example, in the near future. I do think we're going to see that. We're already seeing it, actually. The West just isn't seeing it because it's not affecting the West. People in the West, like you and I, we have money to buy food. We haven't got a problem. I speak to people in all sorts of different places, different countries, Africa, Asia, and they're telling me on the ground what's happening. There is not a lot of food, and the price inflation is through the roof. So this sort of thing will eventually have a knock-on effect. So I can see that. Now, in terms of what you were saying about not seeing a currency reset or anything like that, how would you see then a cBDC coming about? Or don't tell me, Steve, you're not one of these people that thinks there's not going to be a cBDC. Don't tell me that, please.
Oh, I just don't think it changes anything.
Okay.
That's the thing is people think it solves problems, and I'll do this. Let's say you were going to come into my office right now and rob me and take all my cash. Well, good luck. I haven't carried cash. If I need cash, I have to ask my wife. And I don't know how much she has, but she has a little bit. I don't use cash. I don't carry cash. So rob me, mug me, you can take my credit cards, you get nothing. So as far as I am concerned, I work on a digital currency. I log into my bank account. I don't see an image of a stack of cash saying, Steve, this is your cash for you. No, I see numbers. It's the system. People look at a highway and say, well, instead of driving a truck down there, maybe we should drive a sports car. It'll be so much better. It's the same highway. Just because you can go faster doesn't make it different. It's the same system. So if we went, let's say we abolished cash completely, it doesn't change a thing. The system is still the same. And I think that's what people can't see. But as far as switching out of cash to a digital currency, it's going to be very difficult. Where there's a lot of people that are unbanked, they don't have bank accounts, and a lot of industries that still use a lot of cash. It's going to take time, but that isn't the problem. I know people think it's the solution, but the problem is the system, and we don't have anything else. What we have is a system that we keep trying to make work, and we get it to work for decades or longer, and it's fine, and it's not perfect. But my view is we're more like, would I agree that they will use a digital currency as an excuse to reset the system, which will look like a reset, but really be the same thing just with digital currency? Yeah, they're not going to change the system because, think about this. If you are rich and powerful, or rich or just powerful, why would you want to change the system? Why on earth would Jeff Bezos say, you know what, I think this is a phenomenal idea that we should change the system so everybody's more equitable? Yeah, of course he doesn't want that. He's rich. Do you think people in power are going to say, yeah, this is a great idea. The system that put me in power is my family in power for generations. Yeah, let's just get rid of it. No way, zero possibility. They're going to fight to keep the system the way it is because it's a system not only that got them there, it's a system that keeps them there. And I think that's what I think. A lot of people want a more equitable system. But look, I'm with you. It would be great if there was more equality, if more people had a chance. And there are maybe ways to do that. The notion that that's going to happen, I'll assign a zero probability because all these, the wealthiest 10%, maybe even 20, they don't want it. They might say they want it. I don't want it.
Well, we'll have to agree to disagree on this one, Steve, because I have a very different opinion. But that's that. One thing I would say, though.
But let me say this, Noah.
Yeah.
If you look at down the road, and you kind of said, like, we might go through this 10-year period, look, the young millennials, not just in the U.S., around the world, they're going to be able to change the system. It's not going to be, the boomers aren't going to want to change it. It is not until the millennials realize you need to partner up with the Xers, who are a lot more likely to be able to get into office, and because not only that, but we're older, so we're more likely to hold higher positions in companies. Not necessarily true all cases, but just in general due to age, is like, look, you want to change the system? It's going to be the millennials that drive it. They just don't realize that they can do it yet. They have a huge number of votes. All they got to do is partner up with the Xers, and they're the majority. They just don't believe yet. And we don't have a solution. But I'll just say this, switch me to digital currency, and I'll tell you the system's the same. I'll be happy to prove me wrong, but the system won't. It's still the same system.
Okay, what would you say then to this? So I have friends in China, and one of these friends said that when they went on to this cBDC trial, they had a lot of problems because they can be a little bit controversial, and they had a lot of problems. And there was a long period of time where they were locked out of their bank account. They couldn't do anything. They couldn't access their currency. They couldn't do anything. They didn't have any cash. That's why I was thinking when you said you don't carry cash, I thought I couldn't sleep at night if I didn't have cash or some metal or something, because I've, as I said on my Q&A on Sunday, I've been there, Steve, in the military where everything has gone bad, real bad. Yeah. And if I had a phone or something, I'm not going to say to, the local guy, hey, my friend, can I, wire you some money and borrow that horse of yours or whatever? Can I get that big bag of rice? Or something? No, I need some cash. And we've seen this in periods. If you read a lot of the Depression diaries, I did a series on this. One of the main points of advice that everyone said in there was, make sure you've got some cash, make sure you've got some metal, because when these crises happen, and we saw it in 2008, and the banks closed their doors, and we saw it in the Great Depression, the banks closed their doors, there was no cash anywhere, and people were in big trouble. So I just want to say to my viewers, I do recommend, ladies and gents, you do have some cash and metals. But, you know, Steve's a maverick. We can tell now he's a maverick here.
Yeah, I mean, you look back at Hank Paulson when he was Treasury Secretary. They're like, "Why were you Mr. Bailout?" And he's like, "Well, I didn't agree with the bailouts, but when you realize that the banking system failed, he's like, which it was almost or very close to failing, the whole global economy's gone." So, you know, I look at that and say, look, the cash could be worthless too. If the whole system fails, how do you know your dollars are worth anything? And then, okay, so you've got a gold coin. Does your grocery store take gold coins? I don't think so. Are you going to cut that up when you get there? Well, hold on a second. Let me sliver off a piece so you can get your scale out and measure it. Not going to happen that. In fact, I'll argue the guy with the gun at the door who's waiting for you and your gold, he's going to just take it from you. So now all of a sudden, does gold really matter? Or do guns and bullets matter? I mean, like you start getting, if we're going to really degenerate down to the lowest possible level, you know, I mean, there's no way they can let the system fail because the system it's too interconnected. The whole global economy goes.
All I say is Weimar Republic, Steve. What were they using? Silver and gold. Weimar Republic. So anyway.
Right, there you go.
Okay.
Yeah, you got it exactly right, my friend.
I always say, when anyone comes on, we're never going to agree on everything.
No.
And that's
I don't think the system is going to change as fast as people want it to. I think that's a harsh reality that people just have to accept. Is we may all want it. We don't even have a foundation of something to start with. It's like saying, let's get a new car. Let's design a new car. Well, where are we going to start? We've not done one bit of work to create it. And we got to have it built in a week. Man, not going to happen.
I got a next question for you.
Yeah, let's do it.
All right. So we touched upon, you mentioned earlier on about MBS, mortgage-backed securities, and just the asset sheet at the Fed now. So I did a calculation I think it was 2-3 weeks ago now, which shocked a lot of people. And that was that 53% of the assets held by the Fed were MBS, mortgage-backed securities. On their balance sheet, it shows some other assets of the 47%. So there's gold, there's treasuries, What do you think or let me ask you this way, do you think any of that 47% is in the stock market? Do you think they own any companies, or do you think they might do this in the future? You don't think they'd ever do it?
The Fed has no authority to buy equities. And whatever they did buy, they'd have to list on their balance sheet. I mean, if people think the Fed is some black box, they are audited. I mean, let's just put it realistic. Let's say the Fed was massively cheating and buying equities, and Congress found out. Do you think the Fed exists much longer? No. If you listen to the Congress when they have the Fed chairs testify, you can tell Congress hates the Fed in general. Why? Because the Fed has powers Congress thinks they should have. Why can't we set monetary policy? Why can't we set interest rates? Why do we need this independent board that we have effectively no control over that runs all these dials? No, they don't want it. They want it in committee. So if the Fed were out cheating, Congress would eventually figure it out. Because, and let's think about it. If I'm the Fed, I'm buying stocks. Isn't there a counterparty at somewhere on an exchange? And in this technological world, couldn't we find out, isn't somebody smart enough to be on the other side of that trade to be like, you know what, I know for a fact the Fed is buying stocks. So I'm going to call up Powell and be like, hey, buddy, unless you give me billions and billions of dollars, I'm going to expose you. You'll lose. You'll be done. The Fed will be done. Now everything about you is gone. And I'll just call my congressman like, I have hard proof right here of what you're doing.
Did you ever see Ron Paul? Did you ever see that where he tried to do? I mean, when was the Fed last audited? When was Fort Knox last audited? I just want to give context to this. I don't know if you ever saw these Congress meetings. Janet Yellen sat there and said, we sit outside, we're not answering this, I'm not interested. She was just like, point blank, no, no, no. And Ron Paul was really trying to, and not just him, so many senators have tried to really get across to the Fed they want to audit it, or Fort Knox, I won't even get into that. So just a different point of view on that.
Well, again, why isn't some banking employee come out? Are these people being bribed to such a level that they won't talk about it? I don't believe that for a second. So, I mean, if I was literally worked at a bank or some exchange where I was seeing this order flow coming from the Fed, why, there's not a book, there's not a paper, nobody's talking about it. So it's not happening because that information is almost arguably the most powerful information in the world, because you can shut the Fed down tomorrow. If you could prove to Congress today that they are cheating and violating the Federal Reserve Act, the Fed is gone. Done. But no one has any proof. So it's all speculation. There's absolutely no evidence. And if I was the Fed too, it's like, if someone said, "Oh, Steve, we need to find out if you're cheating on your wife." I don't cheat on my wife. I never cheat on anybody. So the fact that I don't want to talk about it isn't that I'm saying I'm trying to deflect. It's saying I don't do that. So look, there's nothing to discuss. There's nothing to investigate. You can do whatever you want. You'll find zero. So why would the Fed even pander to what is likely a bogus statement? There's no evidence, zero. And if there was evidence, why doesn't someone listen to us talking right now and put the evidence out there? Say, I have material fact. Here's the stocks the Fed is buying. I can prove it. Good. Go to the major news source, and you're going to change the world. You'll be famous. It's not happening.
Could they inadvertently be doing it, i.e., with the swaps? What if it be happening that way?
No, because what is quantitative easing? It's a reserve swap. And this is where everyone gets, oh, well, they're swapping things and the banks are buying stocks. The banks aren't buying stocks either. So people, and this is one of the things that frustrates me is people want a conclusion, so they just go to that. They're like, oh, step here. It's like, well, why don't we start talking about what is a bank reserve? Because if we identify what a bank reserve is, then we know for a fact there's no stocks being purchased, but no one wants to talk about that. So what is a bank reserve? How does it get created? Well, it's real simple. Customers come in and deposit money in a bank. Now they expect to get paid interest on that. Now the banks are not just full of free money to give people on interest if it's sitting in their deposit. So how does the bank get money to pay interest? Well, they can lend against those deposits, or they can take those deposits and buy treasury securities, which we know for a fact that they do, because I can show you a report from the US Treasury that identifies the duration to match commercial deposits and customer deposits. So what the banks do is they go out and they buy treasury securities with customer deposits. And those reserves, those bank reserves, are getting swapped by QE. Again, no stocks in the transaction at all, anywhere.
Okay, let me move on to a different point. So how do you feel about the Federal Reserve owning all of the mortgages then? Because stocks, houses, I mean, two big asset classes here. Because you're very passionate about they shouldn't ever own, let's say, the stock market. But what do you think about them owning all these mortgages?
Well, no, I'm saying the Fed can't buy stocks. People say they are, and they say they're buying them indirectly. I'm saying they are not buying them at all. That is misleading. Now, you could get the argument that says, look, a treasury security gets sold by a hedge fund to a bank because they need it to create a reserve, and then the hedge fund, okay, well, we can go down chain far enough, but it's an indirect relationship. How do we know for a fact that the hedge fund sold the treasury to buy a stock? We don't know that. We're making an assumption. But you look at, why is the Fed buying? Look, I have no opinion on why the Fed is buying mortgage-backed securities treasuries. I'm just saying they have to, because they said we do this thing called quantitative easing, and quantitative easing says we have to create bank reserves. Well, how do you create bank reserves? Well, you need to do an asset swap. Well, there's only two things in the Federal Reserve Act that allows them to do that: treasury securities and mortgage-backed securities. So that's what they're doing. And why do they do it? Again, to take interest rates. Where's my red arrow? You drive interest rates down to create demand for credit. Is it working? Well, you could argue that it's working in the housing market, but we're seeing demand for housing, but we're not seeing an expansion in credit. So it's telling us that's too high. But ultimately, the goal of QE is to drive rates down. Is how they do it. They could buy all treasuries, they could buy others back, they could do whatever they want. But I mean, that's the Fed's business. But as far as that being a leading to equity purchases, or the Fed indirectly trying to buy stocks, it's no.
Okay, so if just the point you said there, that we're not seeing this credit expansion. So how would you explain the asset, like the stock market going up, the housing market going up? where are these numbers coming from then, the digits, if there isn't any credit expansion?
Well, supply and demand. So you have corporations buying their stock back in intent to reduce the supply of it. You have consumers buying on margin, buying option contracts with leverage, doing all kinds of things to buy stocks. You look at the housing market, same thing. Not enough houses, more buyers. Well, it's just simple. You know, if I was going to sell something and I held an auction today and one item that I'm selling and 10,000 people showed up, do you think the price of that item is going up or down? Well, I guarantee you it's going up because two of those 10,000 people are going to bid the price above what everyone else is going to pay. And that's all we're seeing is people are bidding prices up and then just saying, oh, it's due to the Fed.
So you come in from their savings, then it's not because credit. If you look at where these houses are coming, a lot of them, the mortgages, is coming from credit creation in the commercial bank. So I just wanted to get your. I'm just not. Yeah, go ahead.
Okay, well, if you look at real estate lending growth at the commercial banks, it's in contraction. So credit is contracting. That is an absolute fact. So that's the danger is you're seeing this supply, a shortfall of supply, a lot of demand driving prices up at homes. At the time you're seeing credit contract, which tells you that eventually housing prices are likely to contract down because we're in a debt-based economy, we're in a credit-based economy. Credit is going to contract, asset prices are eventually going to contract.
Interesting.
That's the danger. Is you need this perpetual growth of debt. Why do you think? I mean, if people wonder why doesn't the Fed just do quantitative tightening and raise the federal funds rate to 7%? Because it would destroy credit growth. Now, eventually, it would restart after asset prices contract. So the simple answer is you perpetually do lower rates. Well, you can't take the federal funds rate below zero, so you do QE because you can do it that way. All you're trying to do is pull demand forward and get credit growth. But the scary thing is when you start understanding how money is created and destroyed, you realize zero interest rate policy, you should never be there long. Because if everybody, let's just pretend everybody's debt is at zero. Every payment you make, money's destroyed. So as payments are being made, more new loans have to be created. In fact, not just an offsetting number of loans, you have to create even more loans. And that's why it doesn't work. That's why you look at Japan and you say, well, why doesn't zero interest rate policies work? It's because this is a structure of money and people can't see that. That's what's really going on right now is you have too much money being destroyed too quickly. And even though we've seen a lot of what we look at and say, wow, look at all this demand for real estate, it's not enough because rates are so low, so much of that principal is being destroyed every month. That's the problem.
Yeah, I can agree with it to an extent in terms of the payments being made destroys the debt. It destroys the credit. So I get you on that point. In terms of the credit growth in the housing market and some of the other things, and even the buybacks, and in fact, probably not a good example, the share buybacks, because some of that is their working capital, but a lot of it is borrowed money, very low rates. I have clients who are very high up in companies, sit on boards, things like that, and they ask me, what do you think? Should we just borrow all of this money to pay down this, do share buybacks, etc.? So I think, because I sit and I'm very close to it, I just see it as from a slightly different position. But the next question I wanted to ask you was
corporations are borrowing money, but if we look at loans and leases of all commercial banks, look at commercial industrial lending, it's all in contraction. It's not enough. That's what's frightening about it, is you're getting this push in asset prices because people are bidding them higher and higher. But underneath, if you look at the foundation, it's cracking. And that's what people can't see. So I'll suggest that a credit contraction is a very slow process, but when it hits, it's very bad.
Yeah. I mean, that's what a deleveraging is when it all starts to just crumble in upon itself.
Right. And look at the financial crisis, GFC. We was such a shortage of money, right? We couldn't. There wasn't enough money to pay on all the stuff. Well, there naturally isn't enough money. So now we have a credit contraction, a mild one, but it will get worse. At the time, the Fed is tightening financial conditions. You have like two forces that should never be happening together. And yet the answer is, it's not a big, every asset prices will just keep going up because Fed's doing QE. Or everything's going to be okay. The answer is no. You have two dangerous forces that just haven't hit yet. But when they do, it's going to be ugly.
Okay. I wanted to ask you, this is another question. So this came from the community. Steve said recently that the PPI, so this is the Producer Price Index, isn't transitioning to the CPI, the Consumer Price Index. This is contradictory to what you say, Neil. Can you ask Steve why he feels that the PPI is not going into the CPI, and what about the WPI? So let me just give context here. So PPI is the Producer Price Index, CPI is the Consumer Price Index, and then we have the WPI, which is the Wholesale Price Index. So can you, did you get the question there from that?
Yeah, it's simple because the PPI doesn't line up with CPI. I mean, there's things in the PPI that consumers don't buy. So they're not the same. You can't look at them and say, well, producer prices are going up, so consumer prices are all automatically going to go up. You just it doesn't work that way. And you can chart them, and you can see that there are times when PPI is rising and the CPI might be going up some, but not like to the extent. So yeah, they're not directly correlated. We want them to be, right, because it'd be easy to look and say, oh look, producer prices and consumer. I mean, it'd be great, but unfortunately, they're not well correlated to each other.
I mean, when you say that, are you talking about? Are you looking out? Let's say something is let's say something is made. A widget is made in China, then it gets shipped to Korea, then it gets shipped to this place, then it goes to the USA. I mean, are you taking into account the whole timeline of this as well? And also the CPI. I don't go by what the CPI stats say. I don't believe the CPI at all because of all the swaps they do. I'm sure you know about all this with they swap the salmon for the this fish and all the other stuff. So do you not see any correlation with it at all, or the wholesale price index into the CPI? None at all. And then could you give an example?
Not really.
So could you
not really.
The WPI that isn't going into the CPI?
Yeah, I mean, you want to. I mean, like, believe me, I've looked at the charts and been like, yeah, there isn't a tight relationship. I mean, there is there some relationship? Sure. Is it like, okay, I can see one going up, the other will follow? I'll be happy. Please send me a chart. Maybe the timeline I'm looking at is wrong. I'd love to see it, but from what I've looked at, I have not been able to draw those two together.
Yeah. So let's use something like this phone that I've got here then. Right, and we look at the price of it, and then we look back. The things that are required to manufacture this phone, and of course we talked about the shipping containers, and we talked about all the other things. So we go back to even the battery technology that's in this phone. Everything's been going up, yet the phone hasn't necessarily gone up in price at the moment, but I'm sure they will do. Would that be an example at all?
I'm probably not the best guy to ask on this. I just know that from what I've read and looked at, there isn't a strong relationship, but there are people out there that know, like Mike Ashton, he's an expert on the CPI. If you ever want to have him on, I'll be happy to introduce you to the guy. The guy is like a rolling Rolodex of CPI. Dave Rosenberg is excellent. He knows the PPI and the CPI relationship really well. I'd really encourage you to maybe see if you can get them on your show. They'll probably give you a much better answer than I can.
Right.
But I just don't see a tight relationship between them. But that's just me looking at a chart and knowing that there's certain things in one that don't translate to the other.
Yeah.
And so if there is a way, is one 2/3 of the other? Maybe, I don't know. I'm just not the foremost expert on that.
No, that's good. I appreciate that answer, Steve. To be honest, I think a lot of people come on and they give it all this, but they don't actually know certain things. So I always appreciate when you give an honest answer like that. From my perspective, I always look at things and I trace it back. So when people say, "Oh, there's not going to be any food price inflation," Neil, what are you talking about? What's Neil saying? This word shrinkflation. There's no shrinkflation. So I'm the guy that goes to the store, buys the box of potato chips, and come back and go, "Okay, let's open this up. There's nothing in. There's like this much in, and this is all air." I'm that guy. So I always look at it backwards from there.
Yeah, and I think something that people don't look at is they'll say, well, I hear there's all this inflation, right? Steve, you just can't see it. Like, well, I actually do a line item budget. So for someone to tell me that I'm not seeing, it's like, well, I can look and say the price of my internet service, for example, has not gone up in, say, 3 years, but the provider has increased my service level. They're giving me more bandwidth. That's disinflationary. I can look at, I literally just bought an identical, my lease ended, and I just leased an identical version of the car down to every last check of the box, even the color, the same. Price, significantly lower. Disinflationary. So I think people see inflation because they want to see it. If you start looking across the board, it's in certain areas. And if you're not flying or doing certain things, you're not, or buying used cars, you're not seeing as much of it. I'm not doing those things, so I don't really see it as much. I see it in food. But I think I encourage people, if you're not doing a line item budget, maybe you should, because you'll really start to see what's going up and what's not.
Yeah, that's actually a perfect example. I take a lot of flack, and it always, I think my viewers like that, because I'm pretty thick-skinned, so I can laugh it off. And I said we're going to see, I was talking about stagflation, more than a year ago now, maybe 15 months. People said, no. And I gave an example. I said, watch what happens to the airline industry, the hotel industry, cruises, all this. You're going to see prices coming down. And at the same time, you're going to see prices of other things going up, right? In conjunction with the lockdowns and demands. And that's an example of stagflation, inflation, deflation at the same time. This is, these things are going on.
Yeah, and it's also an example of tight financial conditions, because you can have, like you said, prices go up one area, but they have to be offset by declining prices somewhere else. And people are going to struggle with what I'm about to say is higher prices can actually be deflationary or disinflationary if there isn't enough money to support them. And people are like, what? Well, think about it. You're a retailer. You raise your price because everyone's raising their price. And then there isn't enough money, so people can't afford to buy those prices. Do you perpetually leave it up there and say, well, I will insist that someday someone will pay this? Or as that inventory rots on your shelf or lot or whatever you've got, you start lowering it.
Yeah. Steve, I just want to mention one thing, because you've mentioned disinflation a few times. So I'm just pulling up my phone. I've got all my definitions and stuff here, because I want to just explain what that is. So disinflation is a temporary slowing of the pace of inflation, and is used to describe instances when inflation rate has reduced marginally over the short term. So unlike inflation and deflation, which refer to the direction of prices, disinflation refers to the rate of change of the rate of inflation. So I just wanted to get that definition there, because a lot of people, I would say 95%, don't know what disinflation is. So it's good to add to your repertoire, ladies and gents.
Yeah, and it's funny that the definition said short term, but we've had disinflation for 40 years. So that's pretty ironic to me. And that's what I'm looking at, like in the data, like on this Thursday, we see the CPI come out. Now, we can probably reasonably predict that the year over year might be higher. If not, it's going to be probably fairly close to last month. I think we both would agree with that. But I don't care about the year over year, because that can go away the following month when the base effects come up. What is the month over month? And when I'm looking at month over month, is it higher, the same, or lower? If it's lower, it's disinflationary. And that's what I'm interested in, because what we're hearing about is this massive inflation that's going to keep coming. Well, if that's correct, then I should see prints that are near or at the same level, if not higher, to continue driving that year over year rate number up. And we've already seen just this last couple of days some disinflationary prints coming out of Asia and Europe, which will suggest at some point that will show up in the United States.
I want to ask you a final question, Steve. This is the big one. You ready for it?
Okay. Let's do it.
It's the one I ask all my guests, and that is the dollar collapse. Do you ever see the dollar collapsing, either in the short term, the long term? And if that was to happen, how would you see the most likely, because I could name a dozen ways it could come about, but how would you see the most likely way that might happen?
Short term, no. Eventually, yes. No is because it's the world's reserve currency. No, there's no other alternative. No, there's no other payment system. No, there's nothing that can possibly replace it. And no one's done anything to really create something. I mean, I know someone will say, well, isn't that what crypto does? Not not quite. It's not quite that, but in terms of truly replacing the dollar, you'd be more likely to see a crypto dollar of some form than you would actually see a completely different type of currency. But long term, we do know historically that all reserve currencies eventually fail. You start getting into Triffin's dilemma. I mean, yes, it's inevitable that the dollar will go down. It has that will happen. Will it be in my lifetime, your lifetime? I don't know. What I can tell you is the United States will do everything they can to keep the dollar as a reserve as long as humanly possible. I mean, militaristically, we have that. I mean, as a country, we've done a lot of things to ensure that that position isn't going to change. So I'll say in the short term, whatever relative between short and long term is, I don't know. But in the short term, the dollar isn't going anywhere. It may look different. Again, it may become digital, but it's still going to be the dollar.
Interesting. You see, the Chinese yuan, their digital yuan, is years ahead of the dollar. And I was telling my private community recently, I did a video and I talked about what I actually saw when I was watching these people who are responsible for delivering the digital dollar. They were doing their update and all this. And I don't think they were making this up or acting when they said this. But they said the Chinese yuan is light years ahead of where we are working on the dollar. They've got a team 10 times the size. They've thrown loads more resources at it. They're light years ahead, and we're just way behind trying to catch up. Now, that might not seem like a lot when you look at it face value. But then when you track all the things I track, and I like to look way ahead to the future as well. And I think to myself, what's happened over this last year in the crisis and how most countries have gone into this negative GDP cycle. China's done very, very well from it. They're investing very heavily in AI and all sorts of other futuristic tech. The US just isn't really investing that way. In fact, we've now got this, this infrastructure package, focusing on infrastructure. Not that I disagree with it, but we should be focusing on technology, getting ahead there, because the US is going to lose this race. Now, people who say 2035 before China becomes the next superpower, 2040, I would argue that we're probably going to see it by 2028, if not a little bit earlier than that, which then says there's going to be a big problem on the hands of most nations, because you've got this superpower, the US, with a huge army, this superpower, China, with a huge army, and we've got this overlapping, which is going to happen in the next decade for certain. And I think we're going to have a pretty big problem there. I don't know exactly what's going to happen, but yeah.
Didn't we just talk a little while ago about war cycles following recessions?
Yeah.
And oddly enough, right? And so here's why I don't see China becoming the reserve currency, because I don't think they don't want it. I mean, they know this. They're not ready for it yet. And they're such long-term planners. They know they're not in a position to do it. They know they need to get, all the people out of the migrant farmers and all that stuff out of the fields and into the cities. They got time. They got time, but they're very patient. But you're right. The way I look at the reserve currency, if you've ever played the board game Risk, there's let's just pretend there's like a chalice that gets in the middle of the board and everybody's fighting. The winner becomes a reserve currency. And you start thinking about the United States, and as you mentioned, our military and the things we're doing, the payment systems, all the things we're doing what we can do to not only avoid that, but if that does happen, that we stand a high percentage chance of winning again. And then as the winners, we'll just say, you know what? Here's the new game, or here's the new system. We'll change it around a little bit, but here's the new system, and you all have to play because we won.
Interesting. A lot of food for thought. Well, we've been going for quite a long time, Steve, so I think we're probably going to come into the end shortly. You said you've created something just recently you wanted to share with the viewers. You wanted to tell them about.
Yeah, I've been working on. I do things that people say you shouldn't do or can't do, and I've been working on something called Momentum Timer Pro. It was something I built for myself. The concept was I was building for myself and my clients to sort through a massive number of securities to find ones that were low, had high probability of rising. And so I'm currently running an open beta for anyone who wants to jump on. It's at momentumtimerpro.com. Again, it's at my expense, and so they can see the report and be a part of the beta and see if I'm just crazy enough to come up with something that does what I think it can.
Great. All right, ladies and gents, Steve, you can send me that link. I'll put it below in the description. Anyone wants to take a look at that. But thank you so much for being online. Please remember to click the like button. Get that like button. Steve, have you got your like flag? Get it waving. We've got the subscribe as well. Please remember to do this if you haven't already. There you go. Steve's got his flags out. And I'll link to Steve's channel below as well, so that you can find out a little bit more about Steve, see some of his theories, watch some of his videos. But apart from that, Steve, thank you so much. We really appreciate you. Thanks for being online. So great. Thanks a lot.